Thank you for joining Defending FinTech Revenue, where we'll be talking about how to remain relevant to financial institutions, even in the midst of a pandemic. I'm Jeb Beckwith. I'll be your host today. I've grown multiple multi-billion-dollar businesses focused on financial institutions clients. I've adjudicated a $600 billion credit portfolio for a large international bank, and I've developed leading FinTech solutions for things like LIBOR transition, CECL, and Basel III FRTB. On today's agenda, we're going to be turning to how to turn a client crisis into an opportunity. Financial institutions are experiencing two simultaneous shocks. Most people know about the first, which is COVID-19 pandemic and the large economic credit losses that are happening from that. But there's another one that's going on in the lending space, which is an accounting change called CECL. It will require 2 to 5 times accounting credit losses even before the pandemic. So two things happening simultaneously. CECL is coming into play in 2020 for public companies. Budgets are being slashed for fintechs. The only thing that's salvageable right now are must-haves. You can't be a nice-to-have right now. So incremental value doesn't happen. You need to transition your value proposition in the next 30 days from nice-to-have to must-have. So let's explore how to do that. Now, you have really two relationships with a financial institution if you're a fintech. The first is you can sell into them. And if you're a financial institution as a client of yours, you need to pivot again from that growth mindset to the need mindset, the mandate mindset. There's a few ways to do that. CECL is going to require credit insights in models and granularity. The LIBOR transition is going to require, again, model management, process management, compliance, document review is a big one. You need to know and understand which silo you're selling into. Trading budgets remain relatively flush, even though lending budgets remain relatively constrained. So know where you're selling into and pivot to that sector that you're selling into. You need to redefine your value proposition and marketing strategy now to prepare for the mandate, prepare for these mandates. You need to do that within the next 30 days. If, on the other hand, your relationship with a financial institution is your funding partner, you need to understand that customer inside and out. You need to understand that the lending balance sheets are going to be constrained going forward. That means less revenue for you. You can alleviate that, mitigate that by making your loans more capital friendly in a CECL compliant way, provide transparent, robust, and timely data submissions, consider new structures which are CECL friendly, for example, shortening the tenor of your loans and making more balloon structures. These changes and others can save your partner up to 50% or more in capital. That means more revenue for you because you're doing more lending from your partner. You can revise this strategy and make a very quick pivot within the next 30 days. You'll make your clients happy, but more importantly, you'll make your long-term financial partners happy. This differentiation from your competitors is going to allow you to drive market share. You may even develop new revenue streams for both you and your FI partners. You can fortify these existing relationships for the long term. They're going to remember you now when the chips are down. So in summary, you want to embrace the change that's going on with your FI partners. You want to defend that revenue and gain market share and know your client. I hope you have enjoyed this, learned a little bit. Please give me a reach out either by LinkedIn or by email. My contact information is below. I'd love to hear your thoughts or comments on what I've just presented. In the next turn, we're going to be talking about the LIBOR transition and how to turn that LIBOR transition into a client loyalty exercise. Thank you very much for your time, and I look forward to hearing from you.